Over to you, Victor.
Hi, everyone. Good evening. Thank you so much for your time and joining us on this Friday evening. The time is just past 7 o'clock. I'm mindful that some of you are probably waiting to have dinner or have other engagements. This session should not take more than 30 minutes, including some question and answers. And if you want to stay on, by all means, we can continue beyond 7:30 to answer any extra questions that you may have. Thank you so much, Teresa. And as the others are coming in, I will proceed tonight. Basically, I wanted to share with you how kids can actually invest with the technology that we are bringing to the table today. So on your screen, you should be able to see Squirrel Safe, Smart Investing. So that is the website. And if you have the time or you have a QR code reader, please go and check us out. First of all, meet Sasa. Sasa is our mascot. And she wants to tell you that with Squirrel Safe, even kids can invest today. And that's what we're going to share with you. This is a bit of my background. It's useful knowledge in terms of why I do what I do. I have a cross-industry experience in investments, insurance, and healthcare. And I've been involved with technology and transforming and turning companies around. And that's why I created Pivot, which is the company that owns the brand Squirrel Safe. I want to start off by giving some context. As adults, we invest, or we say we invest. But, you know, if I could use pictures to represent how we invest, then these pictures are quite funny to me, but it captures how I think people invest. They actually take risks which they're not aware of. And I'd like to say that when we invest, you know, I think it may be good for some of us to go to the horse race and invest there, because the way we invest is almost the same as betting on horse racing. So you pick a horse, you analyze the horse, you look at their trial times, you look at their weight, you look at the jockey, his track record, you look at his latest weigh-in, you look at the conditions of the turf, and you look at data, and then you say the odds are. And in fact, that's what the turf clubs do. They calculate the odds, and therefore you might bet on an outside dark horse, so to speak, and if you put $1, you can win 100. But you could lose your $1. So horse racing, if you're familiar with it, which I doubt you are because you're of the modern generation perhaps, but a lot of us are doing the same. We're horse betting, but we tell people we are investing. And I'm starting with the adults because I want your children to do it right and do it better than us adults. Because when we say we invest, actually, the mathematics and the psychometrics and all the psychology studies show that we are actually betting, speculating, or gambling. And yet we say we're investors. We're not. We're gamblers. So here's some younger generation, some newer photos. These are real, by the way. I hope they're still alive somewhere. But at some point, the probability of them being able to grow older is going to be less if they conduct more of such activities. But they seek this. They want it. Risk is something they want, though they may not say it. But that's how we, as adults, the older generation, also feel. We like risk. We may not want to admit it. But in investments, I say you better know what risks you are taking. The famous adage is that every salesman in a bank will tell you, or financial advisor may tell you, in order to have higher returns, you need to take higher risks. But they forget to tell you the other 50% and mirror image, which they don't tell you because they want you to buy a product because they're attracting you through emotion that all of us want more money, more return. We're greedy. They forget to balance you out with a fear that, yes, higher returns means taking higher risk, but higher risk also mean higher potential losses. So the risks are commensurate with the probability of winning, but at the same time, the mirror image is the probability of losing. And in real life, people don't tell you that. So I want to make sure your kids don't fall for that sales tagline. So in essence, investing should be managing risk before chasing returns. But we humans chase returns without knowing the exact risk we're taking. But let's not blame humans, because managing risks 24/7 these days, because global markets are so interconnected, it's not humanly possible. And I say in our last webinar 2 nights ago, diversification is not a new secret, is the only free lunch in investing. And this gentleman, Harry Markowitz, who's also known to be the pioneer of modern portfolio theory, has shared that you can squeeze extra returns simply by diversifying, by removing risk or reducing risk. And I think that makes absolute sense. So rather than chase returns, let us reduce as much of the systemic risk, and therefore you get the extra returns. And that is how we came to doing what we do. But I could also manage your portfolio actively. So I also said I could diversify, but I could be buying, I could be selling, I could be diversifying. But you know, I have worked as a stock analyst, a stockbroker, a fund manager, a private banker, and so on. And look, the truth is, when technology wasn't available, I was telling the truth. But with today's technology, if I do the same thing I used to do 10, 20 years ago, I will be lying to you, because active managers are also horse betting on your behalf. But instead of betting on one horse, I bet on the Australian horse race, the US horse race, the Singapore horse race, because we're living in Singapore, obviously. And you know, we're so close to Malaysia, we'll bet on the Malaysian horse race. And within each country's horse race, we pick horses. And not only that, in Singapore, there'll be horse race number 1 to horse race number 8. So they're like sectors within the country. And we can bet on this race number 3 and pick 2 horses and 5 horses. And then I say I'm diversifying for you. No, the evidence clearly shows that such behavior over the years have not been able to beat the market consistently. They can proudly, and I used to say, hey, I did well last year, but I didn't tell you that 2 years ago I didn't do well, and maybe the following year I do badly, because we take turns to do well. And that's called random hypothesis. So really, the data is glaring and is allowed, but no active manager wants to proudly market this to you. I'm telling you, as a former active manager, the data is damning. Well, it's a simple test. If we're so good at managing your money, why do I need to manage your money? I can just manage my own. I'll be richer than anybody else. But the truth is, we're not good as humans at active management, and we're not good at diversifying, because the volume of data today is way above human capability. So let me then lead on to the products that we are being sold in the market. We're being sold unit trusts, where the manager actually invests for you, but they are horse betting. And here on the screen is what we have created. Squirrel Safe is a smart, intelligent system using artificial intelligence techniques to process data in real time. The purpose of which is to analyze the probable risks and to maximize the returns that are possible, that are predicted on probability, given the risk you're willing to take. So on this screen, it's a snapshot from our website, but we're also on the Apple Store as well as the Google Android Play Store. Download those apps, please discover and come on board and join this new journey and pathway of smart investing. The legacy players do not want to come on, because what we are offering is going to cannibalize their traditional revenues. So in essence, what we do is make global investing easy. Using artificial intelligence, we target good risk-adjusted returns, not within the next 1 to 3 months, but we look at a time horizon of at least a year, and we think 1 year to 3 years is a good target. If you have more than 3 years, even better. And I will explain why in the next few slides. So our AI technology means that you do not need any investment knowledge. You don't need to make any daily decisions or difficult decisions. You don't need any technical knowledge. So we're accessible to anyone, the financially less savvy, unbanked, and definitely children. All right? You can start with any amount. So the old excuse is, I don't have enough to invest. The minimum to invest in a traditional legacy inefficient unit trust is roughly 1,000 Singapore dollars. And you can buy one country fund. What's the point? And they say they don't have enough money. But today, with smart investing that we offer you, you can start with $1. That means even children with pocket money can now save, meaning invest for the long term. So the important thing is to know yourself, what risk you can take. Now, let me share with you the basis of our technology. Basically, the world is very interconnected now compared to, say, 15, 20 years ago and 25 years ago when I started analyzing stock markets. In those days, data was hard to come by, and to contact someone halfway around the world was very expensive. Today, the markets are interconnected, and there's higher correlation between the markets than 15, 20 years ago. Today, we all look at how the US closed at 4:30 our time, and then 9:30 in the morning, we know what to do. So the markets, and we look at Australia, which opens before us. We look at Japan, we look at Korea. So the markets tend to be more correlated. Coming back, it means that there's a lot of data across the whole world. No one should be investing only in Singapore. We should be investing across the whole world and look for something that is not so correlated to achieve the fruits of this free lunch in investing called diversification. And all we need is the price of a security. And there are thousands, hundreds of thousands of them. And the price will generate the return, which is the difference over time. And how it got from point A to point B over time is called volatility or risk. And all we do using artificial intelligence techniques is to crunch the data. And we look at alternative data, like the sentiments, technical data. We look at what people are talking about in the media. And our AI then says, this is what the pattern looks like. And it can do it in real time. So we use AI. That's very important for you to understand. In terms of structure, well, we start right at the bottom of this slide. We start with a data lake, all right? Then we have a factor layer, and we cover things like emotions, right? Surprise indices. We look at technical factors. Then we have the strategy layer. We use factor analysis. SVM is support vector machines, which are AI techniques or mathematical models, which can do separation, and so on. We have PCA, which is principal component analysis. Those of you who are in coding or in statistical analysis or data science, that is reducing the number of correlated explanatory factors so that you can reduce the number of autocorrelations and so on and so forth. Solution layer, finally, is what you see as a customer at the front end. So if you go to our Squirrel Safe website, you see a calculator for wealth accumulation, retirement, education, and just to invest. And we will also do principal protection down the road. So that's basically our structure. And this chart shows you mathematically what we mean. These are not things which are new. These mathematical models exist for decades, all right, 50, 60, 80 years. However, it's only in recent times, maybe in the last 5, 6 years, that our computing power and the connectivity of data across the internet is so efficient now and low cost that we can run these mathematical models in real time, consuming data that is beyond a human. So let me watch.
Investing is never simple. So much information, too many products. How do you protect your assets? Squirrel Safe solves these problems for you. Tailored to your age, assets, and investment objectives, Squirrel Safe provides a personalized asset management solution. Works 24/7 for every stage of your life based on your needs. The transparent Squirrel Safe algorithm is built on Markowitz's Nobel Prize-winning modern portfolio theory. Your tailor-made portfolio will be diversified across different investment markets with exposure to domestic and global assets, seeking returns while mitigating risks. Our machine learning AI algorithms have been trained with more than 12 years of past data and 3 years of real-time market information. Squirrel Save goes beyond traditional static asset management by adjusting to real-time market changes in line with your personal risk profile. By dynamically allocating across asset classes with low or negative correlations, Squirrel Save controls volatility to preserve and grow your wealth. We deliver good risk-adjusted returns consistently. We make low-cost investing available to everyone. We innovate by using AI and machine learning. We make global investing easy for everyone. We create value for you. No knowledge needed. Simply decide your risk profile and we do the rest. More than 12 years of training, tracking 574,000 real-time global factors and analyzing over 21 million data sets. Presenting your personalized portfolio in seconds, covering 5 continents, 15 asset classes, 35 countries, and over 2,000 products. Squirrel Save. Smart investing for anyone, anywhere, anytime.
Thank you for watching that video. That sort of explains what we are doing. And moving on, so some of you may be interested to see how we construct the portfolios. It's really no different from our traditional classical way of looking at broad asset classes, and then we look at sectors. The difference is that at Squirrel Save, we use exchange-traded funds, of which there are 2,300 or more now, that are listed in the United States that we use to represent these different asset classes. And then we apply it to our AI models, where we look at the different factors. It could be technical factors, as we showed you earlier, fundamental factors, and even sentimental indices. And then we look at the algorithms. And these algorithms can be single factor, multi-factors. And then we have a second order machine learning that looks at all the different predictions by the different algorithms. And then it knows that among the different algorithms, the track record of predicting it to be correct in hindsight is so much versus that, and so on. So we have a second order machine learning tool, and then it generates the output on the right-hand side of your graph. And it actually shows you, all right, the weather patterns, whether it's going to be thundery, it's going to be sunny. And we know that when the weather pattern is sunny, certain factors do well. Or when it's very cold and it's storming hailstones, right? Certain other factors do well. So all these things then translate into our predictions for the various asset classes in the market and the volatilities. And then we apply it to this optimization model, which I mentioned earlier, Harry Markowitz, modern portfolio theory. And we apply it to this model where, in simple terms, it basically looks for the highest possible return from combining different assets together to minimize the risk. So in other words, it tries to maximize the return or minimizing the risk. But how much of how low a risk do you take, or what risk do you take? That risk, we set it and match it to your personal risk that you set for yourself. So we therefore use the algorithm to find a combination of asset classes that matches your personal risk, and then find the combination that gets you the highest predicted return. And that's in essence what modern portfolio theory will do mathematically. Here are some results. We modeled our algorithms and benchmarked it to a very long-term savings plan called the CPF investment scheme in Singapore, which is meant for retirement. We benchmarked it to the mid to high risk setting. And the orange graph shows you our model portfolio, which if you look at it since 2004, if you started investing there, you will be many times better off than investing in the CPF benchmark. So that, in essence, is what this slide shows you. So the model has worked quite well. Now, let me bring you to the next idea of time horizon. You can see on the screen, there are 6 charts, 3 on top, 3 at the bottom. You can look at the patterns. Obviously, the one maybe here in the top center is, quite volatile, right? Compared to the center bottom, which is pretty stable, except for this period, all right? So it'll be interesting to ask, what was this period? It's a real big drop, really big drop. Well, the other way is, look, wow, this one's even smoother, perhaps. Yeah, it's got jags here, up and down, but you notice that, and it's very interesting, when it goes down, it normally has a V. It normally has a V when it drops sharply. The question is, when it's dropping and you're an investor or a fund manager like me, we don't know where the bottom is, right? So we always say it might be a falling knife, right? So you can see all these V's. These are very interesting patterns to analyze, and the data, the AI can just analyze it with no bias. But let me now introduce a bias as a human. What are these charts I'm showing you? Are they all different things? Well, let me tell you, they're not. They're actually all representing the same thing. It's called the S&P 500, the world's biggest stock market. It's not a US stock market. It used to be, I argue, when I first started stockbroking 25 years ago, it was the US market. Today, S&P 500 represents the top 500 companies in the US. But you know, many of the top 500 US listed companies get a bulk of their earnings from the rest of the world. So these companies are not US companies. They happen to be listed in the US. But coming back, it is showing on this screen, all 6 charts show the same thing, S&P 500. And it shows, I've taken roughly about a 25-year time span, 25-year time span, all right? But which one is 25 years and which one is 1 day? Now let me show you, okay? So the one is 1 day is on the top left. The one center top is weekly. The top right is 3 months. And that is 1 year. So no prizes, I'm afraid, for guessing what this one is. This is the COVID crash. This is the COVID crash on February the 19th. Looking in hindsight, nobody knew, but it bottomed out on March 23rd. And if you read my blogs on my Squirrel Safe website, it was during this crash that was telling people that there has never been a good time to invest. You just start. But in the middle of this crash, and I at that time did not know where the bottom was, I said, just invest. It turned out to be good if you had followed the advice. This is a 5-year chart, center bottom, and bottom right is a 25-year chart. So what I want to demonstrate to you is that if you invest and take a very short-term view, you are gambling because you don't know whether it's up or down. But when you can take a 1-year view, okay, this is not the best example, but it's lovely to show you a crash. A 1-year view, you draw a straight line through roughly, it's still trending up. It's still trending up. But you might have panicked here as a human being and could have sold, which is what people normally do because they can't hold anymore, especially if they've leveraged. But if you take a 5-year chart, even with this COVID crash, you can see that it's a pretty straight line. And this 5 years, all right, does not capture the last major crisis that I also witnessed as a fund manager, and that's the global financial crisis. And then, of course, the one before that, the Asian financial crisis. And there were many more crashes in between that were not as big. I've lived through it. And I can tell you, the markets trend up unless we're going to economic depression. So here, the 25-year chart, you can also draw a straight line. So if you try to time the markets, good luck. I hope on chance you get it right, but you may get it wrong. So there is never a good time to start investing. You just start, and with a time horizon of 1 to 3 years, you should overcome any crash, because any crash that you can see did not last more than 3 years. All right. Most of them are showing V's. All right. So that is what the data is telling us. Here, I want to share with you the S&P 500 again, this time showing all the different crises. Watergate scandal, all right, and many other bank failures. Mind you, without looking at the extreme right, these moments were very volatile, very volatile. But because we've moved into the future now at 2020, looking back, you can't even see the drops in the market. They're all no longer magnified. They've been diminished by time. You can't see the crash. But look at it now. The more recent crashes are very clear. 9/11, You've got the global financial crisis over here. And then after that, with QE, quantitative easing, pumping of helicopter money, we've seen the markets go crazily up, crazily up. It's very scary for me to look at this chart. Can you imagine if we were born around here and our parents just invested for us? But forget it. In those days, the stock markets didn't really exist for a lot of people. So I would say the stock markets began to exist for more people around the 80s, but only those who were educated. And definitely in the 1990s, where online stock trading or online gambling came around, more people could invest, all right? So you could explain for a lot of money going into the markets. And I can tell you today, your child can invest as well. Scary, huh? But what is the message I'm telling you? The market writes out every crisis, and time is what we need to smooth out volatility or risk. So it's very important to know from this table, every crisis, and here we show you actual numbers, there are many more crises, the returns that dropped, negative returns during these crises, they're scary, all right? Scary. But the returns in the following year are amazing. And the average return over the next 5 years should tell us that we should not worry too much when there's a crash, because on probability and data, we seem to have done the right thing in response and the markets recovered. So the message is you need a longer time horizon to smooth out volatility. So who has the longest time horizon? Our children. So let me share with you some lessons that we should learn. Stay calm and invest on, avoid market timing, reassess your comfort risk level, stay diversified, and harness the power of compounding. Start early. And so that's why today I say we have now got Squirrel Safe. We're using AI. It's available. Your children should be investing. So bear with me with this video now. So that was our children's education program. Now I want to tell you, we have launched KidSave. It is an account that you can set up for your child or for somebody else's child. So a short video about it.
Start them early. Let your children see their savings grow. Introduce your kids to the world of smart investing with Squirrel Safe AI.
I want to now show you This is the screen. If you go to our website, we are also on the Apple Store and the Google Play Store. You can go to the Add Gold page and you can see on the right-hand side, KidSave. And when you invest with KidSave, you actually have access to our financial literacy program for children, which is called Squirrel Treehouse. And we have got our mascot, and she's part of this acorn squirrel family, where you've got Dada and Mama, and then you've got Momo, her brother, who's about money, and her little sister, Gigi, who likes to give and give. So we teach people about basic financial lessons. What is a need and what is a want? How do you count money? And the differences, the virtues of saving, spending, and sharing. All right. So this is just a very short clip on one of the books we have.
I will work hard to earn more money.
Eating out is expensive. Let's buy healthy vegetables to eat at home.
Look at the price and quantity carefully. Some vegetables offer more value than others.
You have learned that when you spend, you save less.
And even if we spend, we can share with others.
So very importantly, whether you're investing for yourself or for your child, you need to understand the risk and the returns. And I'm very happy to show you our performance that actually went through the COVID-19 crash. This is a sample of what happened in March 2020. The S&P 500 fell 34% from 19th of February to 23rd of March. In comparison, the portfolio which I started as the first customer in testing out the system, which started on the 1st of June 2019. 1st of June 2019, I started. I invested 15,000 Singapore dollars. It fell during the COVID a total of 10%. Look at the difference. So we diversify using our AI. We have a smaller drawdown than the index, which is not actively diversified using machine. And this is as of the 18th of May 2020. Now let me show you what happened 3 months after that. In May 18th, the S&P had recovered, but it was still 14% below its peak. In comparison, my reference portfolio was only 1% below the peak. So because I fell less, I was able to recover faster. So the secret of managing risk through diversification is very important to navigate market falls. So when our fall is less, the chance of us recovering faster can be seen from the screen. The next thing is I want to show you as of 18th of August, just now was 18th of May, now 18th of August, 3 days ago. What was my portfolio? 17,344, all right? I had put in 15,000 on the 1st of June. So it's a period of about 14 and a half months. This is a very aggressive portfolio. All right, started June 2019. It hit 16,000 plus in January, got hit by COVID-19 after that. But before it was hit, it was delivering me about 7% in 8 months or 11% per annum. Then of course it fell in March, but it recovered 3 months after the peak. And 3 days ago, it was standing at 17,344. What's the return? It's 15.6% in 14 and a half months. If you adjust it for 12 months, it's actually 12.9%. If you put your money in a bank account for yourself or for your child, you'll be lucky to get 0.2% per annum. This is 12.9% per annum. Of course, it's subject to risk, but it is risk managed using AI. On the right-hand side of the screen, you can see that for 15,000, the machine has allocated my money into 9 asset classes, including cash. Now, as a former human fund manager, I can tell you, I can't do this for $15,000. It's too small. It's too much work. And very importantly, the AI put me into go from November last year, which human fund managers queried me and say, why is the machine doing that? It's pretty strange. But fast forward to today, we now know why the machine, for some reason, picked gold. Gold has done very well for my portfolio, obviously. Now, I want to tell you, this Squirrel Save doesn't require you to invest 15,000. Here is a $1 portfolio, which I set up in May just to prove a point. As of 18th of August, this conservative portfolio, it's not even aggressive, all right, is now standing at $1.02. $1.02. It started on 18th of May 2020, 3 months ago. It's now got 2% return in 3 months. So roughly for a year, it's about 8% per annum for a conservative portfolio. And not only that, for $1, you get 10 asset classes. The machine decides this. I don't. All right. The machine is running. We're watching the machine, and it's 10 asset classes, you know, and it's got a good exposure to gold. Gold is about 14%. So let me also show you another $1 portfolio as of 18th of August, but this time a very aggressive portfolio. And it was started 5th of May, 3 months ago. It's delivered in 3 months a 5% return. $1 became $1.05. That's equivalent to a 20% per annum return. We're not saying this is going to continue for the next 9 months, but mathematically, it's looking at an annualized 20% forward. And if you look at the diversification, it's got 9 asset classes, including cash, with a very, very good exposure to gold at 25.3% and NASDAQ at 37%. So that ends my presentation for tonight. I want to share with you our invention, our collaboration, our manifestation of what I believe in called Squirrel Save. It is meant to help everyone invest smarter, but most importantly, you need a longer time horizon to ride out risk, and your children, our children, can afford that. And they can start from $1. So it's time our kids invest. With that, I hand over to Theresia. Thank you for listening.
Okay, thank you, Victor. Is it better to start investing later than earlier using your system, since machine learns and gets smarter over time?
Oh, absolutely not. You should start yesterday. Our machine was trained on 12 years of data, and it then has another 4 years of data now to validate. So it's been running, this algorithm was already running in China in 2016. We brought it out of China, we improved it for Singapore for our own needs, and now it's our own algorithm. So you should not wait. The system is running very well already. Well, maybe someone may be asking, is it expensive to invest if we're going to start accounts for children? Well, we only charge a 0.5% flat management fee, whatever amount you put in. It's simple to understand. That's the purpose. And it's very low. If you invest in unit trust, you need a minimum of 1,000 Singapore dollars. There's a front-end charge. It used to be as high as 5%. Sometimes it's 3, 5, or whatever. Some people can get it for 1. But the point is, you actually have to pay a front-end charge. At Squirrel Save, there's no front-end charge. The management fee for unit trust can be 0.75% to 1.2% if it's an active managed fund. At Squirrel Save, it's only 0.5%. The difference, however, is that Squirrel Save charges a performance fee. I believe in it because we want it to perform for you. And the good thing about a performance fee is that it's aligned with our customers' interests, that if we make money for the client, we get a cut, and we get 10%. And that 10% comes from something you don't yet have. So it's not taken up from your initial capital. Whereas in the traditional investment products, they take the front-end charge from your capital. So if you go to a unit trust and you invest 1,000, there's a sales charge of, let's say, 3%. So they take $30 away from your capital on day one. We don't do that. So that's something that I just want to share with you. And even for children, it's a very reasonable sales, or what you call revenue model.
Okay. Another question, can this algorithm do quant?
Quant? Don't really understand that question. Algorithms generally are quantitative. So we're already doing quant, but we're applying quant or numbers or formulas using a philosophy of optimizing, maximizing returns and minimizing risk. So that's called optimization. We're using quantitative methods, and quantitative methods are not new. I used to do it in university many years ago, but I had to look for the data, I had to crunch the data, I had to change the equations. Today, I'm merely using the machine to do it for me in real time without me telling it what to do. It's learning on its own. It's called machine learning. So we're already doing that.
Okay, the next question. Are all positions for the portfolio long or any shorting involved?
Okay, I don't want to do fancy stuff. Investing should be kept simple. So I only stick to going long and do not use shorting, because shorting means there's also downside. We do not do leverage as well. Those are very risky ways of investing. We do not recommend that. So for plain vanilla investing, going long is good. However, if the markets are falling, what do you do? Well, the truth is, when markets fall, not everything falls. There are some things that don't fall and go up. So the machine is able to spot those things. The other thing to note is that I mentioned, as you saw in my screen, 9 asset classes, 10 asset classes, including cash. Cash to us is an asset class. So let's say the whole world is doing so badly, we should be sitting 100% in cash. So our AI knows that as well.
Okay, next question. Earlier, we saw that S&P fell 35% during the crash, while Squirrel Safe portfolio only fell 10%. What was the key reason for this outperformance?
Good question. The entire thing is based on diversification. The machine has already diversified the portfolio. Remember, I showed you some of the portfolios, there's an allocation to gold. In the old days, when I was a fund manager, I would put maybe 2 or 3% maximum in gold. But my portfolio had 27 or 28% in gold. Another portfolio had 14% in gold. These are very bold decisions. And that's why human fund managers who saw my portfolio in November last year were wondering, hey, that's a bit strange. But now it's no longer strange. It's proven that the machine and data does work better than human biases who say that gold is a non-yielding asset. So we should not be investing too much in it. But that's not true. So the data is very clear. Our diversification through our modeling is the reason why we did not fall as much as the S&P 500.
Okay, next question. Can this algorithm do high frequency trading?
No, our algorithms are designed, as I said earlier, on modern portfolio theory. The mathematics is available online for anyone to download. It's not a black box. It's a transparent methodology. What we have done is to train our machine who's made those mistakes, and it's learning on its own. It's machine learning, which is a form of artificial intelligence, machine learning techniques. So that's a key thing. It's actually already trained.
Okay, based on the diversification, what are the products chosen for our portfolio?
Okay, we choose exchange-traded funds because exchange-traded funds today, honestly, are the most suitable investment product for anyone. You should not be buying investment-linked insurance. You should not be buying unit trusts. You are buying dinosaurs. Exchange-traded funds are transparent, low cost, and efficient. And they are already by themselves diversified, but they track specified asset classes with very clear data feeds. So ETFs are what we use, and they're very efficient.
Okay. Let's say I invest $1,000 versus another person. The other person invests $10,000. Is there any difference in terms of the cost structure?
The cost structure is the same. All right, the cost structure is common. However, the cost structure will vary because of the performance fee. Your $1,000 will have a different performance from the $10,000 portfolio, obviously, because the machine will choose the assets to fit your 1,000, and likewise the 10,000, it will choose a different set of assets for that 10,000. The other factor why it may be different is your risk setting. So I presume you're asking the question, 1,000, 10,000, but both choose the same risk setting. Then the difference is in the size of the investment that you put in. But the fees management fees will be the same, but the performance fee may be different.
Okay. If it's 100% AI, how are humans involved in the decision making?
Good question. The humans were involved in the original design. And remember, I didn't invent it. It's a Nobel Economics Prize winning methodology. The mathematics is available on the Excel spreadsheet for you to download. What we did is to design the mathematical modeling, and we trained the machine. Remember, I said earlier, we trained the machine with 12 years of data. And now it's got another 4 years of running since 2016 to 2020. So it's got another 4 years worth of extra data. So the machine's been learning and improving. So, but there is a limit to the improvement. Let me make that clear. If the AI is more than 50% correct in telling me whether it's black or white, that is called AI. All right. If it's not AI, it should be 50% random. But if it's more than 50% correct, it's already AI between two outcomes. Our statistics are showing it's around 52 to 56%, and that is fantastic. If you go anything higher than that, I don't need to invest money. I can do other kinds of stuff. But no, we haven't invented or written those algorithms to do those other things. We only wrote our algorithms to do modern portfolio theory, to diversify, to give you highest possible return for the risk you take.
Okay, who's the custodian of the securities? What will happen if, touch wood, you guys close shop?
A common question, and it's a simple answer. Your assets are safe custodized by our broker custodian called Saxo Capital Markets. And all your securities are separate from Squirrel Safe. If anything touch wood happens to Squirrel Safe, your portfolio is still there.
Okay, for the same risk profile, are my holdings the same if I invest a lot or small?
No. Let's say you have two persons, person one and person two. And let's say person one and person two come in and say they are very aggressive. But very aggressive is only my way in marketing to tell you you are both very aggressive. But mathematically, let's say on a scale of 1 to 10, very aggressive, what does that mean? So for marketing labels, we just say 8 to 10, we call very aggressive. But person one could be 8.5 and person two could be 9.5. But both are called very aggressive, but we are mathematical. So we know that person one is not as aggressive as person number two, who's 9.5 versus 8.5. So we know all these details in our machine, but I as a human don't need to know. My machine knows because there's too much data. And so your portfolio will be different.
If it's for the same person, whether I invest 50,000 or if I invest $500 only, would the holdings be different?
Okay, assuming you invest on the same day, assuming you have the same risk number. Let's say both person one is 9.5, person two is 9.5. Same number, invest on the same day. But one person one invests 500, person two invests 50,000. Your portfolio will be different. Why? Because our AI is a lot more efficient and has more, in mathematical terms, more degrees of freedom when roughly you invest more than 15,000 Sing. All right? It has more degrees of freedom. When you invest less than 15,000 Sing, you have fewer degrees of freedom because the machine, we have also designed a trade optimizer, which looks at the cost of executing the trades. And so we may not execute those trades because your capital is a little smaller, all right? So in that case, your two portfolios will be different. The only time that it will be the same, theoretically, is when the markets are flat. It doesn't move. Then everyone, no matter what your risk profile, will be the same because the AI knows there is no volatility in the market, right? Okay, so I better not go too technical, but the answer is, for the layman, it's really the bigger dollar you invest, the more degree of freedom my AI has. Because in the real world, it's not my charge. The brokers charge us a minimum trading cost. So if you have $500, my machine doesn't want you to pay too much trading costs. So your transactions are slightly different. Okay, so your portfolios will be different. Okay, I hope I answered that question.
Okay, will we be in if there is an event of rebalancing?
No, we are running a discretionary asset management service. So when you sign up, the agreement says that we are not running an advisory portfolio. So we do all the decisions for you. We keep it simple. And for even children, they don't need to worry about whether to buy or sell. Our machine does everything.
Can I invest using my CPF funds?
We are hoping to get CPF to approve us, but we haven't met their time track record yet, which I believe is 3 or 5 years.
Okay, I think this is the last question for today. Is 15K quite a good amount to start investing with?
I'll be honest with you, you can start with $1. The truth is you got to start early and don't move the money in and out. Put the money that you can afford to save for the longer term so that we can ride the volatility, maximize the AI for you. But if you have more dollars, the mathematics, the degrees of freedom are better. So I would say definitely 15,000 or more is even better because there's more degrees of freedom to diversify and manage that portfolio. And it's the machine talking, not me. Okay?
Okay, I guess one last question. How about SRS?
Say again?
How about SRS? Can we invest with SRS?
Okay. SRS is controlled by the banks in Singapore. The banks technically don't want these new fintech startups like us to rock their boat. We're trying to shake the tree to say, can they include us? So we hope that in about 6 months, we will be approved by at least one bank, but not yet.
Okay, I think that's all for today, looking at the time. So thanks a lot, everyone. Thanks for the questions. Regarding the lucky draw, yes. So I will be emailing you separately regarding the outcome of the lucky draw. So if you have any other question, feel free to reach out to us via Facebook, WhatsApp, or just go to our website and you can find our email as well.
Wow, this one not very well diversified. So the chance of winning is very high. But congratulations to whomever, all right?
Okay, thanks everyone. Have a good night and have a good
weekend, everyone. Thanks, Teresa, and thanks to everyone. Thank you very much.
Thank you.